All right, time frame aligned ranges with the high time frame key levels, right? Like I mentioned in the core concepts, we are always trading a range. In one way or another, we're always trading a range on all time frames. We want to blend the high time frame key levels on the long-term perspective with a lower time frame range. This supercharges the probability of the high time frame key level. And when you do this, you're going to see big improvements in your trading. Okay, so the time frame alignment for the range for LTP key levels, okay? When we're looking at a monthly key level, we want to see a daily range to pair with the monthly key level. When we're using a weekly key level, we want to use a H4 range to pair with the weekly key level. Daily key level, we use a H1 range to pair with it, okay? So let's first start off with a monthly key level to a daily range. Right, so we obviously have a monthly key level here, right? Fair value gap. From internal, we're looking to trade to external here. This would be an opposing key level, as well as the small little fair value gap here, right? So from discount key level here, from this range to this range, discount key level to a premium key level. We then trade a daily range when we're using a monthly key level. Right, so we have a daily range high here. Why? This is the high, right? So remember, the range is lessened. This is the high that's obviously connected to this low, right? This here is a range, and so is this, right? Because this high is also connected to this low. So both of these would be a range high, right? And then we have 50% of this range, okay? We trade below into the monthly key level. We accumulate the stops below the daily range low. Then we see the market close above. The down close candle can be used as an order block, then expands really aggressively here. Doesn't really give any more entries on the daily chart until we get above equilibrium here, right? Massive expansion. But this is how you pair a monthly key level. You need a daily range to trade it, and this is what supercharges key levels and makes them a lot easier to trade. Okay, weekly key level with a 4-hour range. Okay, so we're going to look at the weekly fair value gap here. That sends price lower down below relative equal lows, right? So this is how you want to look at the chart as we approach the weekly key level. So if you were looking at the chart in real time and you had this weekly key level mapped with your anticipation that price is going to trade into it, you first need to look for, is there already a 4-hour range created around the key level? If there isn't, they're going to form one. As it's trading up to it, a false high will be made, and then we'll run out that false high, creating that range, right? From here to here, let's say a false high formed, it retraced, that would be your range that it's induced just before the key level. We'd run that out, then sell off aggressively. In this case though, we do have a range already. Okay, so your eye should start identifying the range high, the range low. We pair it with the weekly key level. We wait for price to trade into the weekly key level and into the 4-hour range. And then we attack the range low, equilibrium, right? So as we accumulate the stops above the 4-hour range high, we then are using the market structure as well and the PD arrays on the range time frame to frame our trades on the way down, okay? So as we accumulate the stops here, candle closure, close below this down close candle, changing the state of delivery right there, so you're bearish from there. We then form a displacement, okay? Market trades back up into the fair value gap here, then sells off aggressively. Here closes below equilibrium, uses equilibrium as a reference point here, and then aggressively sells off to the range low as well as relative equal lows right here. Okay, let's look at a daily key level with a 1-hour range. So the framework for this trade, if you guys remember from the previous episode, we hit a monthly key level here, we expanded higher, we then formed this one candle. Okay, now here's a tip for you guys, and you want to get your notepads out for this one. When we have one candle and price closes within it, okay, this one candle technically becomes a consolidation candle. And what do we do in consolidation? One of two things, right? Either a breakout of the consolidation, a retest, okay, and then expansion, or an AMD, right? A soup of the range. Okay, Okay, so because we closed within here, this all becomes consolidation, accumulation, manipulation. Then we start to see distribution. We then form a daily key level here, which is what we're going to use. So as we have this daily key level mapped, okay, you should start looking at 1 hour ranges once you have that key level in mind. And you can obviously see this low is obviously connected to this high, right? So this is your range on the 1 hour for your daily key level. You wait for the range to get taken. We're using the change in the state of delivery on the same time frame as the key level, the same time frame as the range. We close above the 2 down close candles here, change in the state of delivery. We then trade back down into the confirmed OB and aggressively attack the range high. Okay, so this is super important, and this is really going to be a big difference in your trading if you apply the ranges with the correct time frame alignment, and always wait for a range to be induced for the high time frame key level.